whenever I'm doing presentations like this, and it's a relatively small group, there's about 30 people here, I can keep going and I can talk, but the better feedback I get, because it's not like I'm presenting in a room and I can look out and I can see people shaking their head like, okay, I get it, and you know what I mean? So I'm getting a little feedback. Or else sometimes I'll just talk, and then if I don't hear any questions or if I don't get any response, I'll just keep going. So I just want to make sure that the information is, you know, practical for your style of trading, but also on your educational level as well, because there's going to be a lot of, right? There's different people on here, some beginners and, you know, all the way up to people who trade for a living. So I'm going to start here, and it's starting on infinity, but I'm going to talk about the spread margin, because this will give us a natural path into looking at the charts. So infinity futures, and Patrick may have an updated one. This is from a couple of weeks ago, but it's pretty darn close. What this is Infinity's just getting this from the mercantile exchange. I believe these are they're called span numbers. So using the indexes, if you do like 5 NASDAQ to 3 Dow, margin separately is going to be like 32, but on the exchange margin, you're going to get that credit, right? So you'll be able to be short 5 and long 3, and instead of paying 32,000 a margin, you'll get 11,000 a margin, because that's an exchange recognized relationship. They're recognizing the correlation between the NASDAQ and the Dow. Okay, that's all that's saying. So in a sense, it's you know, if we just talk layman's terms, the argument is if NASDAQ's down or up 1,000 points, the Dow's probably going to be up as well, right? They're not going to just completely move in opposite directions. They can, it's possible, anything's possible, it's just not probable. So that's why you're getting the margin relief. So the overall message, or why I wanted to start here, is if this style of trading resonates with you, it is an absolute no-brainer to call Patrick up and set something up with Patrick, because you don't want to do this trading outside of Infinity Futures or a firm that gives you that exchange traded margin. Right, we have S&P, NASDAQ, Dow, Russell. Tick size, value per tick, multiplier, and then you get the contract value. And the contract value is just going to be the multiplier times the index price. So you want to back into the contract value. You see the contract's value of the S&P, NASDAQ, and Dow are all right around the same price. So you could do 1-to-1. Because they're all around the same price, and to get the spread ratio, you could just do 1 divided by the other. If you divide S&P into NASDAQ, it's just 1, right? I mean, I can get a calculator and give you the exact math, but 1-to-1 is fine. If there are really big moves in one of the indices and not another one, you might see these change. But for right now, for simplicity purposes, when we're doing ratios, we're going to do Dow, anything Dow, S&P, or NASDAQ is 1-to-1. And then anything to do with the Russell is going to be 3-to-2. Okay? Yeah, so Rahul, if you do a trade where you sell one S&P and buy one NASDAQ, a company like ThinkorSwim is going to look at that as 2 different trades, and it's going to give you margin on each one of those separately. Infinity is going to use the net calculation that's provided to them from the CME. Patrick will touch on that, more in depth, but there's a huge advantage, like not even close. Donna, did I just say back into value? Donna's just saying, what do you mean by back into value? And I'm not sure. Did I just say back into value? I don't know. I usually do say back into value, but usually when I'm looking at charts for like mean reversion. So Donna, we'll come across that again. No. Donna, I'm going to clear up your questions once I get to the charts. The spread margin from Infinity, guys, is going to be directly from the exchange. Yeah, so Patrick just hit on chat. The difference between the cash value is very, very close. And that's the contract value. Just use the multiplier. So for simplicity, I would just do 1-to-1. And then for Russell, you could do 3-to-2. And I think you'll be just fine. Okay. Okay, so now let's look at some charts. And we'll look just Dow against S&P. Now all I'm doing with this Dow S&P, yeah, Mike, it's recorded. We'll send it out to everybody. And if you guys have any questions specifically about margin, Patrick's out there too. So if you just put the question in the question box, Patrick can reply to you one-on-one. Okay. So in front of you is just Dow minus S&P. Okay. Obviously, if you just did S&P minus Dow, you're just going to see it's going to be reverse, right? ES minus YM. It's just flipped. It doesn't matter which way you do it. So if we look S&P Dow, and if we notice it's kind of hanging out in this kind of relationship, and then it goes down, when it goes offered, if you were short S&P and long Dow, you'd be making money as it comes off. Okay? Whenever we talk about buying or selling, we're always talking about the first one. So if we do it S&P against Dow, and we want to buy this spread, you're buying the front one, and you're selling the back one. Gary, I'm going to share with you the margins that I have. When Patrick starts speaking, he may be sharing some more updated one. Okay. But we'll make sure you get all the margins. Okay, so everyone follows just how that spread works. As it goes lower, if you're short S&P and long Dow, you're going to be doing well. And if it's down here and you want to play like a mean reversion, if you want to play for the spread to go higher, you buy the S&P and you sell the Dow. So you'll be short the S&P and you'll be long the S&P and short the Dow to take advantage of a mean reversion move. So Tom, great question. So Tom says this chart means the Dow, the S&P is closer, is cheap to the Dow? No, not yet. I just want to show you how the spreads work. Okay? Then we'll start analyzing it to find some value. But we can't really find very much value just looking at one pair. Okay? Because if you think about it, and So if we're looking at the S&P and the Dow, so we don't want to just get a feeling for, which one's cheap and which is expensive. They're moving against one another, right? So S&P might be moving like that, and the Dow might be moving like that. So we're just looking for the difference of when that opportunity presents. But what's really important to recognize when you're trading these type of spreads is the S&P and the Dow. The S&P is 500 stocks, the Dow is 30. They don't have to do the exact same thing. So if we were using a different example, and we were using, gold against gold, okay? If we traded gold US against gold Europe, and they're both 100% gold bullion, they're the exact same thing. The only difference would be they're traded on different exchanges, or there might be a little bit of currency risk. Well, those are going to be, really, really correlated. If one gets out of line, heck yeah, it should get closer together. There's no reason that gold shouldn't be trading the same price as gold. But the difference is when you're using indices, S&P Dow, they're correlated, but they're not correlated like gold versus gold, right? Their correlation might be 70%. And so what we want to do is figure out between the S&P and the Dow what's expensive, what's inexpensive relative to one another, but then we want to go further, right? I would say all four of them together have right about the same correlation. When I was with a futures firm, what we did is we would look at things like this: RTY, NASDAQ, S&P, Dow. And if you'll notice, small caps all the way to large caps. So in my opinion, and I have not run a correlation analysis on this, this is just my opinion, but it's a strong opinion. I think that the S&P and Dow are going to have a higher correlation. The NASDAQ and S&Ps are going to have a high correlation, but Russell against the Dow, the little guys against 30 stocks, not as tightly correlated. Okay? So that's just something to keep in mind, I guess. If we do analysis between these four and we determine that the Russell is by far the cheapest and the Dow is by far the most expensive, well, I want you to think back to right now and say, I remember Jonathan saying we should be careful about, the real little companies in the Russell, trading them against the real big companies of the Dow. Let's start analyzing some markets. Now, what I have here is going to be, the top left is going to be Russell against Dow. The top right is going to be Russell against S&Ps. Russell against NASDAQ. And then this is going to be S&Ps against Dow. So let me cover this bottom one. Okay, so now we have, the top is going to be Russell versus Dow. I'm just thinking about the best way to display this. And then we're going to have Russell versus Nas. Russell versus S&P. Now on the first chart, as we look at it, you see we're just looking at all these on a 30-minute. Notice how it's downtrending. Okay? So in order to make money on this trade, you would have been short 3 Russell and long 2 Dow. So right now, if you were to do a trade based upon just simple, like a mean reversion, you'd want to be long the Russell and short the Dow. So let's say long Russell and then short Dow. On this chart here, Russell against S&P. So, John, great question. So, John just said to define mean reversion. So, reverting to the mean is just, it's the average, right? A mean is going to be the average. So, when you trade correlated products that have a very tight relationship, overall, if those relationships break down because of their correlation, they should come back to having, a strong relationship. It's like a rubber band. Rubber band, you can pull, it's inevitably coming back. When you trade spreads, when you trade correlated instruments, you want to sit around and wait for those correlations to break down. And what that means is wait till those correlations break down on a historical basis. And when they do, that might be a trade opportunity. It would be like, if I scroll back up to that gold example, right here, gold breaks down, this is a reversion to the mean, right? The mean, it should have been more like this, but these markets move around on supply and demand. Anything could happen. If a hedge fund is long a whole bunch of European gold and they get a margin call, if a big trader is long a whole bunch of gold and Patrick calls them up and tells them they got to cover, they got to cover. They don't have a choice. So that's what's going to create trade opportunities. What the trader is really doing, guys, is the trader's goal, the job, is to keep markets in line. It's to make things more efficient. Okay? Oh, John, my pleasure. I will get to somewhere with all this. So we're going to go through this, but it's all going to come together for you. So the first trade, if we were going to do a trade, we might think that we want to buy Russell and sell. Stephen, I'll get to that. Stephen's asking, how do we determine the mean from these charts? What I want to show you right with this example is how to look at the 3 or 4 different indices. And then we'll get closer to talking about how do we determine good value. So top left is going to be long Russell, short Dow, right? If we wanted to take advantage and buy down here. If we want to buy Russell ES, we'd be buying the Russell and then selling ES. Can't draw without a color. Okay. That's over here. And then for Russell Nas, that one seems like it might be different, just looking at all these other charts relative to one another. So if anything, that Russell Nas, it's either neutral, or maybe we'd actually even want to sell the Russell and buy the NASDAQ. Okay? So then what I would do, just using these 3 charts, and I'm using them on a 30-minute. Again, you could use these on a 15-minute or a 60-minute. I'm just walking you through these examples. because the Russell is weak to the NASDAQ and strong to the other two, we can cancel the Russell out. And then we could just look that the NASDAQ seems weak relative to the Dow and relative to the S&Ps. Okay? So then we'd want to start looking at, let's switch this, and let's look at those other two charts, which are going to be NASDAQ Dow and then NASDAQ S&P. So this will be NQ minus YM, NQ minus ES, and then we have the S&P Dow down here. Okay, so overall, I would say through this analysis that NQ weak relative to the Dow, now it's strengthening up. NQ weak relative to the S&Ps hasn't really strengthened up like the Dow has. But then we can look at the S&Ps relative to the Dow. And so just by looking at all these, it seems to me S&P Dow, so long NQ, short YM, long NQ, short ES, and then looking here, oh, that's why it's on an hour. That's why I was getting confused. Looking here, S&P against the Dow. Just putting these on different time frames now. Our objective, guys, so our objectives by going through this exercise is either we want to look for a spread trade to do one against the other, or if you're doing an outright trade, with I know many people on here are doing outright trades, you just want to make sure that if you're buying something, you're buying, what you think is relatively inexpensive. It seems like the S&P and the Dow, the S&P and the NASDAQ are inexpensive and the Dow is expensive. Right? All these charts are going to take us to the same place. Long NQ, short YM, long ES, short YM. Another way of looking at this same exact trade would be looking at the NQ like this, and then just overlapping it with the Dow, which will take us right here. Okay, that'll also show it. Again, relative value type trade, but just going back on a little bit of data, just one over the other, you notice how correlated, moving together, but then all of a sudden, the Dow is real strong relative to the NASDAQ. This, to me, would be a decent trade. You could buy one and sell the other. Sorry about that. You could buy one and sell the other. Or if spread trading is not your thing, I would look to buy the NASDAQ if you wanted to go long, but if you wanted to go short, I wouldn't get short the NASDAQ. I would want to get short the Dow. And that's always making sure that we're in the right contract. Another thing that I think is a really great way of trading is if you were trading NASDAQ futures, which are the blue line right here, and you sell a NASDAQ future and you're bearish on the NASDAQ future, instead of looking at the NASDAQ future as a stop, you could say, well, I want to stay in this trade until this line down here starts to rally, because it's a relative value trade. So if you're short, actually this is the Dow, if you're short the Dow and the NASDAQ keeps going lower and the Dow's not really moving, you either want to be patient or you want to add, because the reason you got into that trade is improving. Another great way to trade this is you could sell some Dow up here, and as the NASDAQ comes off, you could buy the NASDAQ instead of buying back your Dow. And for coaching clients, I like that approach a lot, because I find that retail traders are going to get out of their winners way too quickly. Does anybody find themselves having that problem where the losers, they'll talk themselves into and make reasons of why it's still a good trade, but when trades go in their direction, they're not really taking advantage of that? Yeah. And that's a problem that happens with everyone. It's a problem you see a lot too with professional traders. But if we just use this example in front of us, and just remember the Dow is the light blue, and the NASDAQ is the yellow. If you're short the blue, I'm just going to call them blue and yellow. If you're short the blue because it's expensive relative to the yellow, as you get short, if it starts going your way, do you see how that can really benefit you by buying the yellow rather than buying the blue? Because what you're doing is you're bringing your margin down, which is an advantage that we have, that you should take advantage of it, right? So if you're short the blue, you don't have to just cover the blue. You could be short the blue and then buy that Dow slowly to cover your trade, and it still keeps your upside in play, because not only you might be right with direction, you might be right as far as the relative relationship between these two comes back to, this area or trades more of like that. And I find that's a great way for people to stay in trades longer and longer and longer. We always tell the membership, and some of the guys make fun of me that I say it's okay to make a whole bunch of money on one trade. And sometimes we have to do that by tricking ourselves. And a good way to trick ourselves, I got 15% of the room already answered that they covered too quickly, which probably means it's closer to about 70%. But two good things are approaches that I use to stay in trades longer. For one, write down the reason you got into the trade. If the reason you got into this trade is because there's a breakdown in the relative value relationships, fine. Then challenge yourself not to get out of that trade until the reasons of why you got into that trade no longer exist. The other thing that I like to do is to manage these using pairs, because if you sell the blue and buy the yellow, the blue doesn't move and the yellow rallies, well, maybe you take profits on one side of the trade and do that and trade one side of the trade. Hey, Gary. So Gary's asking the difference between the overlay chart like this and the earlier just NQ minus YM. There's no difference. It's just a different way of looking at it. A question now about the time frame to look at charts. Whenever I'm doing technical analysis, I always want the most amount of data first. So I'm always going to start with a weekly, then a daily, and drill into shorter time frames. It's really important to make sure that you're doing the analysis, your technical analysis, based upon your trade time frames. So if some of you are sitting there and say, I'm only a day trader, I will not take positions overnight, well, you can use a longer term chart for a bias, but if you're just trading that day, you probably don't need to be on a weekly chart, right? The time frames aren't really going to reflect your time frame. You can see here, going back on a daily, how these two have come together. We can compare it to the Russell. We're not going to get great data on because it's a new contract. But what we could also do with the Russell is just use an ETF. So if we compare it to an ETF, you can really see how they all behave going back. We can look at even longer term data. And this chart's really telling. So the yellow is the NASDAQ, right? No surprise, the NASDAQ's been the strongest. Technology. Big surprise. But watch what happens. I'm going to take the NASDAQ off. And the reason I'm going to take the NASDAQ off is because, you know, if we go back this far and doing this kind of analysis, the NASDAQ has really, you know, it's on a mind of its own. It makes me think that if the market gets destroyed, you know, the NASDAQ's got a big tree fall hard, you got a lot further to fall. But if I take off that NASDAQ and it looks like that, can you see the benefit of doing this kind of trading, looking at that chart going back to 2011? Because when these trade opportunities present themselves, the most important thing, if we see something like this, is when you're trading, whether you're an outright trader, a spread trader, you know, whatever kind of trader, you just want to make sure, I'll take this, that if you're looking to get short, well, the Russell's the most expensive.
Okay. Hey, guys. Yeah, this is Patrick. I think we may have lost Jonathan for the moment. I'm still here. I've been kind of listening in the background, so maybe I'll just kind of fill in until he gets back. Is that okay? I know I'm not going to give you the analytics he will, but maybe we could talk about some of the other stuff. All right, cool. Yeah, Rahul, my little brother Marcus is also a representative of Infinity. Yes, he's younger and not as smart as me. He's a great guy. Yeah, keep it in the family. Okay, hey, I'm going to take the screen real quick. Let's just wait. I'll just wait till Jonathan gets back. Hang tight. Everybody can see the screen with the PDF there, some of the margin examples. Okay, cool. All right, so this is a document that I put together this morning. So earlier today, I was in contact with my risk management desk, and I asked them to update some of these margin requirements. So these are margin requirements as of today for these various exchange-recognized spread ratios. So you may have seen in the chat box that you do get a margin discount if you go long one and short the other. And it's actually a decent discount too. I think that, let me see what I typed here earlier. So for S&P against NASDAQ, it's the margin's 22.50 if you're long one, short the other. And for one S&P against one Dow, the margin's $1,995. So it's not a horrible discount. You're still getting, you know, a $2,000 roughly margin requirement instead of about $10,000, right? So it's definitely significant compared to margining those positions separately. But these ratios also exist here. So 3 Russell against 2 Dow, margin is 46.65. 3 Russell against 2 NASDAQ, 62.47. The only one that looks a little weird to me is this one here. because the NASDAQ used to be a lot smaller than the S&P, and now it is no longer much smaller at all, right? It's about $5,000 smaller, which is way less than it used to be. It used to be about, usually the NASDAQ would be $30,000, $40,000 less in terms of the contract value, and now that it's caught up, that spread has narrowed. So I think that this ratio is relatively new. This used to not be even. Now it is. So I don't know why they quote it in fives, but really you could do 1-to-1 here and theoretically get the lower margin requirement. Okay, Russell against S&P, 44.62. Okay, one of the things that I wanted to touch on the charting side, and anybody who wants a copy of the chart files, maybe after the fact, just email Jonathan directly.
Hey Patrick, can you hear me?
Oh, hey Mike. Oh yeah, Jonathan, you back?
Yeah, sorry about that, guy. I had no idea.
I was covering for you for a few.
No, that's awesome. I appreciate it.
All right. You want to take the screen back? I'll come back later when you're ready.
No. Sorry, guys. I was now all the questions just popped in, so I must have been down. Patrick, you're more than welcome to keep going. I can finish up whatever.
Okay. All right. Yeah. Do you want me to throw just? I was gonna maybe throw up a couple things on the charts real quick, and then I can. Yeah. I don't want to take too much time.
No. Hey, as much as you want. It's important stuff.
All right, cool. Well, we'll just kind of go down this road. Now, one of the things I wanted to show everybody that we didn't really talk about in some of the other webinars, and I heard Jonathan mention it today, and he and I had not really discussed it, but there is a study that exists inside Sierra called full contract value. Okay, so full contract value, like if you look here on this S&P chart, full contract value takes the current index price, which is in the case of the S&P is 2631, and multiplies it by the point value for each one, which in this case is $50, right? All right. Yeah, I'll make them a bit bigger here. I made these see, this is a huge monitor, so I have to make these charts small because when I send them to people, they don't fit on the screen. So that's why I make them this small. But let me just expand these out a little bit just for now. Okay. So in the top left here, this is the S&P at 2631. Down here, right below that, this is a study called full contract value, which all it does is multiply the price times the value of the per point of that index, which in the case of the S&P is $50. Okay, and then what you see over here is this is the NASDAQ, and this is doing the same thing. So it's taking the current price of the NASDAQ, 62.91, multiplied by the point value, $20, and it yields this value. And then what you see happening is this value here is being overlaid onto the S&P chart. So you've got the S&P, full contract value of the S&P, full contract value of the NASDAQ, and then one minus the other. So this value here at the bottom is simply this one, the S&P value, minus this one, the NQ value, which yields the actual cash value spread between these two contracts. Okay, so the reason I made this big one over here too is to show you that it doesn't have to look like this. If this is like makes you crazy because of all the lines, this chart that's on the far left is the same as the chart on the right. It's just displayed differently. So the one on the right is omitting some stuff that you may not find relevant. Like if you only need to see this line, you could just see this line. You don't have to see everything. All right, but this is a good example of the S&P against the NASDAQ, and then I made other ones as well. But I made a whole bunch of ratios as well. Here's the S&P against the Dow. So let me just make this one a bit bigger as well. Okay, so on the left-hand side, you've got the S&P, and then here you've got the Dow. So S&P, full contract value of the S&P, Dow, full contract value of the Dow, this value overlaid onto the S&P chart so that one can be subtracted from the other, which yields this. This $10,612 number, which is moving in real time, is the actual cash value between the two contracts, and that is being graphed over here. So one of the cool parts about Sierra is that there's a bunch of arithmetic studies built into it that allow you to really do anything like this that you want to do if it's not already built in. So it's a pretty cool idea. Now, just to complicate things a little bit, we also, and there's the NASDAQ against the Russell, and I made a whole bunch of other ones. Let's look at the Russell against the NASDAQ in the ratio. So this one throws an extra step in there because what you're seeing is you're seeing the market itself, you're seeing the full contract value, and then we're multiplying it by 2 because this is a 3 Russell against 2 NASDAQ spread. So I'm actually multiplying the cash value by 2 contracts, overlaying that value over here. And then the Russell, in this case, it's a multiplier of 3. We have the cash value of that contract multiplied by 3, and then that yields this value. So this is the difference of the actual exchange recognized spread, negative 24,835, and then that value is being shown over here. So the reason, again, I'm showing all this stuff is because if you just want to look at just this window, you can. If you want to look at the other stuff, you can too. It really depends on how tolerant you are of extra lines. Okay, so it's a pretty cool program. When we did the event with Jonathan last week, we also touched on this style of charting where you can see percentage change on year, weekly, daily charts. We have these as well. So again, anybody who has a demo or a live account now, in fact, the easiest thing to do would be to just email me directly. pz@infinityfutures.com is my email address. I'll put it in the chat box here for everybody. So if you're a customer and you want this, because there's a lot of people in here who are already clients, well, thanks for coming, guys, then just email me directly. If you are using a demo, email me directly. I'll get these things your way. If you are not using either and you're just thinking about maybe exploring the idea of giving us a try, which we obviously would love that opportunity, same thing. Just email me. I'll get in touch with you. We'll get a trial your way, and I'll send you all these files. You can have them, to use as much as you want or as little as you want. Okay, there's no fee. It's not like a paid subscription or anything like that. Okay, and then just a couple of talking points for those of you who are unfamiliar with us. Infinity has a pretty I like to use the word specialized, but really it's narrow. We don't do a lot of different things. Okay, we only do futures. So we specialize in futures. We do it really, really well. We have a great level 2 order entry platform that is free and super light, uses almost no system resources. And so if you want to try the program out, or if you're using, for example, like ThinkorSwim or TradeStation or something for the majority of your actual trades, then give us a good look, because we compete with those companies head to head. And days like Friday when we had that crazy volatility, we got calls from people using these other places telling us that these other programs were useless during those stressful circumstances. And that's just not something that happens very often here, especially under extreme circumstances, because the software uses very, very little of your machine. In fact, our trading dome, the depth of market screen, that if you're not familiar with it, looks like this. Okay, this window here. This trading platform uses less memory on your computer than one tab of Google Chrome. Okay, no exaggeration. So just to put that in perspective, if you're using TD Ameritrade and it's using 95% of your memory, which we know it is, this is not going to impact your system's resources at all. Okay? Okay, cool. So I wanted to get that out there as well. It's a $3,000 minimum to open the account with Infinity, so if you want to give us a try on a smaller level, just to sort of see how things work, we welcome that. Okay, we certainly love the opportunity. Okay? Yeah, definitely, Rahul. Yeah, I agree with you. Rahul says Infinity runs great in a virtual machine as compared to ThinkorSwim, which is a hog. Yeah, we hear the same thing. The use of the resources on the charting side is also very light. It's if you're running, let's say you're a moderate user of TOS. I'm not exaggerating when I say it probably uses 1/50th to 1/200th of the resources required by TD Ameritrade's program. So, and I'm not kidding. It really is a light program. All right, Ken, you have to leg into the spread. Yes, that's true. We are in the process of developing a system that allows you to automatically enter trades based on spread values, and it's actually a custom study we built for the charts. It actually works. We've got people using it right now. It's just not like our typical trading platform. It's something we custom made for people. We don't charge any money for it. We've got people using it now, so if you wanted to explore that, you certainly could do that. The thing that's cool about it is that it lets you run simulated or synthetic stops and targets. So if you were to leave it on at night and you wanted to put a target out there, like a synthetic target, you could do that, and it would trigger as long as you stay connected. So it is something that we're improving our service on. Yeah, if you're interested in that, if you're already a customer, just talk to your rep in our office and we'll show you how to get permission for it. But it doesn't cost anything. All right? Does anybody else have any questions about the margin or about the company in general? Anything that I can clarify? I mean, I've been at this a while. We know our competition really well. We try to shoot really straight with people about risk and the day-to-day trade management, and we're very easy to communicate with. So if you have questions or if you're unsure about whether this is appropriate, let us know. Jonathan does a good job of discussing risk, and obviously his perspective is a little bit different than ours, but we want to make sure that you only have money in a futures account that you can afford to risk. Okay, that's our number one criteria, and B, that you understand that spread margin spread trading doesn't necessarily reduce your risk, and we've seen examples of that in some of the markets like the NASDAQ and stuff lately, where things can decouple pretty quickly and without notice. So just keep your head screwed on nice and tight and make sure that you don't let your guard down. Okay. No, you can still practice once you have a funded account, Donna. So once your account's funded, we're going to give you access to a more permanent simulated environment, and it's a $3,000 minimum to open an account there, JG or GJ. Just send me an email, Donna, with what you're asking about, and I'll make sure that we get it taken care of. That's another Donna, different than Donna S. Okay. All right, cool. Well, all right, great. Well, I'll give it a moment here. I'll be kind of listening in the background. I want Jonathan to keep doing his thing, but certainly anybody who's interested or has questions, please reach out to me directly. We'll get you squared away, answer questions about the platform, margin, how to execute the orders, how to get the charts set up. And again, if you want the charts, there's all these charts at the top. I made them all today. You can see the dates on them. We're happy to send them your way. Okay? Yeah, you can trade off the charts, Peter. Yep. You can trade off the charts or off the dome, and they talk to each other. So if you put an order on the dome, you can see it on the chart, and vice versa. Okay. All right, Jonathan, I think I'm good. I'll be hanging out in the background, okay?
Oh, fantastic. Awesome. Thank you.
All right, man. Thank you. Appreciate it, everybody. Thanks for listening.
All right. Sorry about that, guys. I was in the middle of talking, and I guess I was going for like 4 extra minutes before I looked up and realized that I was down. So cool. Patrick, thank you for doing that. I'm looking at our Vera Bradley trades up 35%. That's kind of fun. Ken, hey, Ken, how are you keeping all the comparisons on the chart? Ken, are you using ThinkorSwim or using Sierra? Here, so up here on the top right, then you can break it up. You can, as many as you want. So when I'm looking at things, I'm usually using these. So Ken, not the grid? The actual chart, how am I overlaying things? Okay. Hit the beaker. And then you want to compare things. Comparison. Add selected. And you can put as many as you want on there. As the members know, I use this all the time. It's really, really valuable. It's really important. So I'm going to go back to what I was talking about when I was talking to myself and nobody was around. And I was just doing historical analysis based on, the 3 different correlated indices. I guess I don't have the Dow up here, which is fine. When I add 3, 2 disappear. Oh, Ken, I know what you're doing, because you're probably adding. So this is going to be your main symbol. And these are 2 extra symbols, so make sure that you're not using the same symbol as one of your extra symbols. Patrick, if you could reach out for Mike's question. Ken, you just don't have something's unchecked. You might have like a show studies is unchecked. Okay. Stephen, sure, they're great. Yes, yes, yes. So what I want you to really understand, though, Russell, S&P, NASDAQ's in front of you. You don't have to be a spread trader. Even if you trade using the cloud, or you have an indicator, or you use market profile, or whatever you like to use, my point is put yourself in the right instrument. If you're going to be long, you want to be long something down here. If you want to be short, you want to be short something up here. Okay? And that doesn't necessarily change anything that you're doing right now. It just adds a few layers before. And that, I think, is really, really important to get to. So we never just look at the S&Ps just in pure isolation. Oh, on the platform, John? Okay. I mean, I have some YouTube videos for that. You know, the live classes. If I get up here, usually people are going to want to, you know, learn something that they can't Google. Okay. I mean, that's where I really try to add value. Yeah, John. Just look at my YouTube channel, and under ThinkorSwim, I have like five videos. But overall, when I present, you know, I want to make sure that I'm presenting something that you can search around the internet and learn. A lot of other people are doing that, and it drives me nuts. All right, cool. Another way, which is going to be a little bit different course, different than we've talked about, but I think you should consider bringing this into your trading, is if you go to the CBOE, and we look at the CBOE vol, which is volatility. Here's another thing that I like to do, and I'll check this all the time, and I'll just put the link in the chat once I get there, if I can get there. Volatility indexes. There we go. So I'm just going to put this link in the chat. And again, members, you guys are going to be familiar with this page. Another thing that we use all the time. And this just takes me back that everything's a derivative of something else. So if you're trading, you know, futures, it's the same as ETFs. They're derivatives. They're all the same. So I just put this page in the chat, and what this allows you to do is you can just look at the VIX, or VXN is going to be your NASDAQ volatility, right? RVX is going to be your Russell volatility. VXD. So it's just going further and further in everything that you do, right? So you have to assume that most retailer traders, and I'll be very general here, are, you know, waiting for breakouts or double bottoms or head and shoulders, okay? Trading off something like a head and shoulders, and again, my opinion, but I have a pretty strong opinion about this stuff because, you know, it's real. But if you're making a trade based upon a double bottom or a double top, how long do you think it's going to take me to explain that trade to my 8-year-old? Not too long, right? And I don't mean to be like, we all have to dig deeper, because so many are just trading off that one basic thing, or even having an indicator that gives you a sell signal or a buy signal without really understanding what's going on underneath the hood. That's why we have to learn. That's why we have to make good decisions. That's why we have to get, you know, away from that dependency on, you know, these different tools. Okay? Unless it's a custom tool that you built and you back tested, but overall, just, you know, even buying an indicator. We're out there, we've all seen them, indicators for $9.97 with no return policy. How many indicators are in ThinkorSwim? 1 billion? We have all these indicators, and then every single one of them we can change the parameters any way we want. Okay? So be careful buying that stuff. Learn something real. The volatility indexes, the way that I like to use these, same thing. I want to compare them, right? If all of a sudden Russell volatility goes up, rallies like crazy, and the other indices, their volatility hasn't rallied, well, for one, without a doubt, you could expect more movement in the Russell, right? The volatility is way higher than it was the previous day. But that's very telling. And then you can look at, hey, that one volatility is going higher. Is it breaking down the correlation? Or is the correlation broken down and now the volatility is rising, so things are changing? Maybe that brings the correlation back into line. Maybe that lets you stay, short the NASDAQ, if you're short the NASDAQ, a little bit longer because you've been in that position, it's working, and now volatility is really starting to spike up. So there's some energy behind the market. That'll also encourage you to be more patient. When trades are good, you need to make money, because we know when trades aren't good, we're going to lose. It's really important to go after it when the getting is good. Or else, if you have 2 weeks and you look back and you say, you know what, that was the best 2 weeks of trade that I've ever been involved with. But then if you look and you make $1,000, but the week before that you lost $1,000. Well, if that week is such a darn good trade, was the week before the worst trade you've ever been in? So it needs to be in line. You got to make money when it's good. You got to make money when you're right. Because when you're wrong, we're just trying our best to scratch those trades, to break even on those trades, to lose as little as we possibly can. So that's why I'm going to do relative value trading. That's why I'm going to incorporate the volatility, because I want to go further than other competitors in the market, than not competitors, people taking the other side of my trades. So if I take this away and then we do the same thing, just using the volatility, VXN is going to be NASDAQ, VXD is going to be Dow, RVX. Okay, that's what it looks like. I put it on a daily, going back, highly correlated, but still. Over the summer, June, July, the NASDAQ got way more volatile relative to the Dow, relative to the Russell. I mean, that's, we're risking money. That's important information to know, right? When volatility goes higher, especially here, it looks like the NASDAQ volatility might have been 10% higher or 15% higher. You got to manage risk differently. We got to trade differently if the VIX is at 10, if it's at 15, if it's at 20. If you trade 5 lots when the VIX is at 10, you don't want to trade 5 lots when the VIX is at 20. Right? That doesn't make much sense. So the same way that you're managing money, you want to manage your position sizing as well. I would think that if you trade 5 lots and the VIX is at 10, when the VIX goes to 20, rather than letting the market show you how volatile it is by, wow, I didn't realize I had this much risk in the position, you got to get in front of it and trade a little bit smaller. I'm sure if I say it to you, VIX 10, VIX 20, it makes sense to trade smaller, but many people don't. Many people learn those lessons in the market. Learning those lessons in the market, learning any lessons in the market, it's expensive. This is on a daily. We can look shorter term. let me just touch on this because, again, I really, really believe in trading an entire portfolio of trading futures, stocks, options, all coming together. But talk a little bit about options here. You'd want to sell options in the NASDAQ, and you'd want to buy options outside the NASDAQ. Whenever you sell options, you're short volatility. Here's something that is interesting. What about this trade? Right around this area. What about getting long the NASDAQ and getting short one of the other two? What would the thinking behind that be? Getting long the NASDAQ and getting short one of S&Ps or the Russell as a relative value trade. Anybody can guess the thinking behind that? Why I'd want to do that? It's kind of a tough one. It's a weird trade. Where is their volatility? If the Dow's up 300 points tomorrow, what's volatility going to do? If the Dow's down, if the Dow's down 300 points tomorrow, what's volatility going to do? Right. Volatility is to the downside. There's trouble to the downside. As the markets go higher, volatility goes lower. Okay? So the thinking behind that would be if the markets get hit and go down, the other two are going to skyrocket because the volatility is relatively inexpensive. If the market goes higher, the other two are darn cheap anyway. They're going to go down a little bit, but look at the follow-through you get in the NASDAQ. Okay? July 3rd. I mean, if you want, I can go to a chart of July 3rd, and I bet you that's exactly what happened. Because look how the volatility came out of the NASDAQ so quickly. I'm just trying to follow the questions. So Ken, the thinking would be if one of these has got to be right, right? So either, here, I'll take off the Russell just because I don't want to, it's not adding any value. So one of these it probably needs to be correct, unless one's going to live at a higher volatility and one's going to live at a lower volatility, and that just shifted sometime in the summer, which I doubt it did. So as the NASDAQ goes lower, you have to assume the market's going higher. What we're doing is, it's a little quasi-hedge. Ken, what do you think? Is this different than how you look at the market? Because what you really want to do is find opportunities like this, which is really, really off the beaten path, right? I'm now analyzing different VIX on the indices to give me a head start. And then after that, we want to go into that next stage, which is where I started the presentation, just looking at the relative value of those different indices. That's exactly how I'd want to trade equity index futures. Okay. Do some of you, Ken says he doesn't really take overnight risk. Do others on here not take overnight risk? I know because there's quite a bit of Patrick's audience on here as well, and the futures traders are going to be more inclined not to take overnight risk. Can you just let me know? Can you put a, do you take overnight risk? Yes or no? No is I don't hold positions overnight. Starting to? Okay. And futures, I mean, futures, they can be a little squirrely. Interesting. So Tom says he doesn't because the risks of gaps are too high. Ken wants me to market as a whole, yes, but as you mentioned, look at gold versus platinum or palladium. But Ken, I don't think that's a very good trade. No, I'm not dealing. No, I'm just curious. So overall, that's how I look at equity futures, guys. What I really like to do is I like being creative, and I like to find different relationships, where people aren't necessarily looking. Okay, so then we take this trade and we do something similar in the bonds. And for those who are, I'm gonna segue a little bit. Does anybody have any questions more about equity indices before I move on? VRA is up 35%. How are those 10 calls for a dime doing? So Raul is saying, how do you quantify when to get in? How can you quantify when the spread's far apart? It's going to be depending on your time frame. There's no right or wrong answer, but what we want to do, if we're just looking at S&P against NASDAQ, and we get something that looks like this. Julie from London. Bye, Julie. Thanks for hanging. So, for instance, S&P against NASDAQ, if I was doing a trade, like this, I like to do one by one. And then if it goes against and they give us better levels, I want to give it a little bit of room. So I usually get in these in groups of 3, like 1 by 1, 2 by 2, 3 by 3. Stephen, you can. I don't. So I won't then, after doing this kind of analysis, if I'm doing a pair trade, this is enough for me. If I just want to buy the NASDAQ based upon a relative value kind of analysis, that's when I'll look for entry points. And the way that I would look for entry points in the NASDAQ, if right now I have a conviction that the market's going to trade higher, that the NASDAQ's going to trade higher, this is how I do technical analysis. It's very simplistic, very straightforward. I've been doing it for 18 years. I never use somebody else's technical numbers because I just think that you need to have the confidence and know where you got your own numbers. So here's what I would do. I would start on a weekly. I always am going to write down highs and lows of weeklies. They're very, very powerful. Okay, highs and lows of weeklies are going to be very good support and resistance. Drill in further. This high right here is going to be 63.45. Yesterday's high is going to be 63.40. So that might be a place, actually, if I wanted to get short, that I'd want to stop behind. As far as getting long, if you'll notice, today's low is pretty much the same as yesterday's low, within $1 of it. Pretty much the same thing here. I really wouldn't want to get long. I would probably want to wait until down here to get long. But that's what I would look. I just want to keep it simple. Maybe I'd look at a 4-hour too, but probably not. Just keep it simple with daily. I just want a bias. I want to know which way I'm trading in. I try to think of technical analysis like I read a great article that Jack Nicklaus wrote, the golfer. And Jack Nicklaus spent his whole career hitting the ball left to right, which is a fade. So when he hit the ball, it would always have left to right spin. And in the article that he wrote, he did that so he knows that whenever he's playing well, he hits the ball in the center of the fairway. But whenever he's playing poorly, he hits the ball on the right side of the fairway or trouble to the right. But he knows that with his swing, he can't hit the ball left. His trouble's only on one side. So that's really what I like to do in trading. Using that analogy in trading, I want a bias. So, for instance, if my bias is to be short the NASDAQ, I'll only trade from that side. I think people get themselves in a lot of trouble when they want to be sellers and buyers and sellers and buyers. And it's like it's a yo-yo where they're not really going to let the index move at all. It's just going to sell it when it rallies and buy it when it dips. I think people get themselves in a lot of trouble that way. So I'll do this relative value analysis, and then I'll even write down saying, you know what, I'm looking for places to get short the NASDAQ. I'm looking at places to get long the S&Ps. And then depending on the market movement, then I'll know that if volatility is coming out of the market's strong, my work's already done. Oh yeah, what did I want to get long? Then I'll look for a place in that index that has been previously researched where to get long. I won't start doing the research then. The research will be done beforehand so I can be reactionary in the market. Right? The market's not going to wait for us. We've got to get in front of it. We've got to be ready when things happen. Okay? I think that's about it, guys. This was a lot of fun. Went in a couple of different directions. I think you guys probably know this, but do you know every Monday I share trades in futures? And then every Sunday I share trades in stocks, options, and ETFs. So if anybody wants to get these trades or try out the service, if you're not a member, I'll just throw it in the chat. You can get a 30-day trial. It's $7. It's just activedaytrader.com/trial. Carrie is my wife and also customer service for Active Day Trader. She's very shy. All right, guys. Thank you so much. It's a ton of fun. Hopefully you guys got some benefit.